I think all investing should be impact investing. Ultimately, every investment fund is going to start looking more and more like impact investing. At some point, you can't quite tell the difference between the two.
Somehow you successfully replaced 3 members of Exxon's board despite holding only 0.02% of the company's share capital.
Vast majority of shareholders are financially motivated, financially focused. You've got to be able to make a very strong financial argument for why it's going to benefit the other shareholders of the company. You are voting with your wallet with every single coffee you buy, where you choose to live, everything, especially younger generations. But all people are kind of waking up to this idea that if they care about a set of issues, they should care about it in every decision they make.
Hello, Michael O'Leary. Does anybody ever confuse you with the Irish Michael O'Leary?
I will, in fact, get some complaints sometimes from folks about what happened to them on Ryanair. And the funniest one was a bunch of friends who sent me this Instagram post. It was a short little video about the history of Ryanair and of Michael O'Leary. And in the little video, it said, back in college, Michael O'Leary did X, Y, and Z. But it showed my picture instead of his. And so it showed my current picture as him back in high school or something. Anyway, so it happens. I did get a complaint recently on LinkedIn. I said, hey, you got the wrong Michael O'Leary.
Well, I suppose if you book a flight from London to Dublin, you probably get really good service. You get a good seat.
I would hope.
Well, thanks for coming on today. So where are you from and where did you grow up?
Oh, sure. Yeah, I grew up in the suburbs of New York City in Connecticut, and then spent most of my early career in Boston, for a while in Hong Kong when I was working with Bain Capital, and now in New York, where I live with my wife in Brooklyn and work here in Midtown.
Right. So Connecticut, what town was it that you grew up in?
New Canaan, Connecticut.
And what was it like growing up there?
They say there's a joke about Connecticut of the two things, if you're ever going through Connecticut, the two things you need to make sure you see: New York City and Boston. The best parts of the state, which I think is a little unfair, but it does. I mean, it was a wonderful place growing up. And I think living in the suburbs of New York, where so many people's parents are coming in and out of the city every day, getting on the train, going in. I think I was always surrounded by commerce, surrounded by finance. And I think it's part of what led me ultimately to want to work in the field and bring a briefcase to work every day.
I guess you grew up there and then you went off to school at Harvard for your undergraduate studies, and you really did the proverbial philosophy major, didn't you?
It's so funny. There's all these articles about the death of the humanities, and you take these big subjects, history, English, philosophy, that, at least growing up, I kind of imagined that's what college is. It's people studying those fields. And then you actually get there. And I think when I was there was out of whatever it was, 1,600 students in my class, there was maybe 12 that were studying philosophy, so it's quite a small field.
How did you actually select that as a major?
Yeah, I loved it. In a lot of ways, a lot of the humanities are trying to get at the same questions, and literature is trying to get at these same questions through novels, and the study of history can get at these same questions of ultimate worth and value and change. And I think the thing that attracted me about philosophy is not that it's trying to answer different questions, it's trying to answer them the most directly it can. I think that turns some people off from the field sometimes, where you open up your first philosophy paper and it's saying, in this paper, I will try to show A, and to show it, I will try to show B, and thusly I will have shown C. And it can be very overly laid out. But there's something nice about saying, these are the most important questions of how should you organize a state? What makes for a just society? What makes action moral or immoral? And to be able to spend, these are questions, I think, that animate all of life and politics, but you never deal with so directly as you have the opportunity to by studying it as an undergrad. And so I quite enjoyed it. And people will go off to law school and things, but to me it was like such a rich vein to mine as an undergrad wandering around trying to think about big questions.
And your parents were good with that?
My older brother studied theology, so philosophy was a step in the right direction.
And when you graduated, what did you do then? I mean, you go get a job or because somewhere I found in my research that you were an economic policy advisor in the Senate. Yeah. And you worked on 2 presidential campaigns. Was that right after that or was that later on? Or?
No, all came later. I went straight from philosophy to private equity. the pipeline, the very obvious pipeline of philosophy to private equity, and worked at Bain Capital in Boston. That was my first role.
How in the world did you go from philosophy to private equity?
Yeah, it's funny, if you had Googled Bain Capital when I first got the job, when I first got the role, before Mitt Romney had announced for president, you get a lot of press releases about deals made, IPOs, that sort of thing. And by the time I started, it was when Mitt Romney was front of the news, and there's all these articles being written that were literally like that. The headline would be Bain Capital's vulture capitalism is destroying America.
Vulture capitalism, I forgot that one. Yeah.
I mean, having just spent my senior year of college writing a thesis about what makes for a just society, at what point can you say an economic system is fair or unfair, it forces you to start addressing some of these questions in practice. And I think my takeaway from having spent a lot of time wrestling with these issues and talking with my other analysts, is Bain Capital. This finance is not an overly Republican space, especially the junior ranks. Like, people are pretty mixed. I think the assessment I sort of came to was critiques of private equity oftentimes are kind of veiled critiques of capitalism itself, of this idea that companies exist or economic exists to maximize profits, society and environment be damned. And I think over time, as I was wrestling with these questions and ultimately what drove me towards the impact investing field where I work now, this idea of that, like, it's not actually quite right that is a representation of capitalism. In many ways, it's actually kind of a perverse representation of a short-term focused sort of capitalism. That if you're actually focused on maximizing the value of companies over the long term, you can't do that, destroying value for all of your stakeholders, for your workers, for the environment over time. Many people can try, but ultimately, capitalism at its strongest is not synonymous with this short-term value extractive caricature that I think sometimes gets painted. And if there is a better way to do it, I think that was sort of the very beginning of my journey towards thinking about this broader field of ESG investing, sustainable investing, impact investing, kind of this cloud of terms, socially responsible investing, that does not represent a departure from capitalism or a departure from investing. In many ways, it represents a better form, a more effective way of creating value, a better way of growing the economy.
So you went in and you literally working on the private equity investing side, but then eventually you ended up on the founding team of Bain Capital's Social Impact Fund, migrated over to impact investing. How did that come about?
Yeah, well, I was quite lucky in that the former governor of Massachusetts, Deval Patrick, who's just an incredible leader and pathfinder in this space, he had led a lot of work around social impact bonds as governor, and so had seen the public side of impact investing. And when he left office, we were all just sitting at our desks and got the firm-wide email announcing that he was going to be joining Bain Capital to launch an impact fund. And at the time, impact investing has been around for a long time. It didn't always have the label impact investing, but there are a lot of people doing it in a lot of different contexts. But the idea of a big traditional asset manager like Bain Capital launching an impact fund was still quite new. This is before TPG Rise had been announced. This was before a lot of the big platforms had launched funds. And so it really was quite innovative, this idea that he would join and be able to champion this fund. And so I pulled every string I had internally to get put on that team that helped craft the strategy, because these were all open questions. What should an impact fund look like at a big traditional asset manager like that? Should it be concessionary returns? Should it look more like philanthropy? Should they be trying to achieve market rate returns? Should it just be focused in emerging markets and doing micro lending? What is the shape of an impact fund within the traditional asset management space? I mean, it was truly a privilege to be able to work on at least one early effort in that space and see just how much it's exploded since then in just the assets under management and the number of funds that have been launched in the last, call it 8 years or so.
Where about you joined Bain, I guess maybe 2012. How far in were you when you moved over to this impact side?
This would have been like 2015, 2016 is when the fund launched.
And you started in Boston, but you also did a stint for Bain in Hong Kong. Is that right?
One of the great opportunities that can come from being part of a big platform, for folks coming out of college who are going to big banks or consulting firms, is you're able to take advantage of opportunities to work across different parts of the business. And Bain Capital has a very successful fund strategy out in Asia. So I had the opportunity, the great joy to go work in our Hong Kong office for a year and ended up working with who ultimately became my co-author, Warren Valdmanis, who had been he's from Canada originally, had been in the States. He was out in Hong Kong at the time and was my boss for that year. And ultimately, the two of us went back and joined the Impact Fund together.
So the Hong Kong part was not impact.
No, but it's funny because you can imagine how, especially where impact was at the time, a lot of impact was focused in developing markets, emerging markets. But no, we were doing, because of the vagaries of the private equity world, we ended up spending almost a full year looking at childcare in Australia. So an impact of a sort, but it was not with the Impact Fund.
During that time there, you went into plain vanilla private equity investing, and then you were in on founding an impact fund. Tell me how, at least initially, impact investing was different than regular investing, especially in the private equity world.
Yeah, it's such a good question. To me, impact investing represents a different thesis, a different investing thesis on the best way to find and create value. So much of our job is the same. Trying to source deals, due diligence, underwrite investments, understand risk reward. And impact has some superficial differences around what metrics are we tracking, which standards are we trying to abide by. But the core difference, like the fundamental difference in what we do as impact investors versus what a traditional fund that might focus on similar sectors would do, is that we have a different thesis on the best sorts of companies to find and back. And then once we're investors in those companies, the right way to grow them. What things should we be focused on as owners and as managers? And so as we were building Bain Double Impact, two things were always front of mind. First, and I believe this for any platform extension of a big firm like that, and the same thing is true here at L Catterton, is to think about what are the fundamental strengths and advantages that this platform has, and how do we create a strategy that leverages those strengths and advantages as much as possible. So in other words, thinking about what is an impact fund that only Bain Capital could build, or only L Catterton could build, or Carlyle could build, or whatever, because it forces you to recognize all investing is hard. Generating alpha, sustained alpha is a nearly impossible task. And so you need to stack, everything in your favor. And that means that, if you're a venture firm, you shouldn't go off and start doing, infrastructure investing. If you're an infrastructure firm, you shouldn't go off and create a venture impact fund. You want to lean back into the strengths of the platform. That's the first thing. And the second thing is thinking about what is the deeper thesis that underlies the fund. Because every fund in many ways is a bet on the future. What is the future of this sector or the economy going to look like? And how do we create an investing strategy that benefits from that? And I think that's where the crucial difference is that impact investors have a different theory about what creates value over time, how to minimize risk, maximize return over time. And then we create a strategy that allows us to put that into practice.
Then you left Bain, and it seems like you took a couple of years off, but I'm going to guess that's when you were at Stanford to get your MBA.
That's right.
And in parallel, you co-wrote a book with Warren Valdmanis called Accountable. In this book, you developed a vision for an alternative model of capitalism, and you called this alternative model citizen capitalism. So tell me more about this book, what led up to it, and then tell me, what is citizen capitalism?
We were spending a lot of time, in these early days at Bain Double Impact, felt kind of late days of impact investing because we were looking at all the people who came before us. Ultimately, we're pretty early days of the kind of traditional asset managers coming into impact investing in hindsight. And we spent all this time debating some of these fundamental questions around sustainable investing, impact investing. Why should it be true that if all other investors are trying to maximize a single variable, risk-adjusted return, and now all of a sudden we're coming in and saying, oh no, we've got multiple different mandates we care about. We care about serving society, we care about the environment, and we care about maximizing risk-adjusted return. Why should it be true that adding in multiple other variables to a single variable equation should not necessarily come at the expense of shareholders? Is there a trade-off, right? I mean, this is the question that many folks new to the space have. And we'd spent all this time debating it, seeing the results on the ground. And I think the impetus for the book, initially the impetus for a few articles that ultimately turned into writing a book, was trying to answer some of these questions from the inside. Why should it be that impact investing, there's no inherent trade-off? And ultimately, we ended up broadening the aperture and saying, we've got these interrelated trends of impact investing, the divestment movement, the broader sets of corporate social responsibility, ESG, different government reforms people suggest. And the question is, how do these pieces fit together? And what do they add up to, if anything? Trying to take a very skeptical, cynical eye to it. And maybe not surprisingly, given her line of work, ultimately coming to the assessment that even if 80% of it is empty marketing, is superficial greenwashing and posturing, the 20% that's real and fundamental represents a better way to invest, a better way to grow companies, a better way to grow the economy. So that was kind of like the deeper thesis behind the book. And then a lot of time spent trying to profile what's going wrong, what's, where's the BS versus where's the fundamental change. And we come to this idea of citizen capitalism because one thing we realized over time is that we've really bifurcated ourselves as individuals into one part moral and one part economic. And the moral part, that governs how we donate money, where we volunteer, how we vote. And yet for so many of us for so long, once we enter the marketplace, you put all that to one side and you say, now it's my economic self, homo economicus. And as homo economicus, I'm just maximizing my own self-interest. And we came to this conclusion of we are one people, each of us is one person. If I care about a certain set of issues, I should care about it not just in where I donate money and how I vote, but also in where I work. One of the most important decisions we ever make, and what I choose to buy and how I save and invest. And when you take that sort of mentality of I am a partial owner of this economy, and there is no invisible hand. It's just us. The invisible hand is the net result of all of our individual decisions and actions. And once you take that mindset to things, you realize we are all citizens of this economy in the same way we are citizens of this democracy. And we all have ownership over the outcome in the same way we have ownership over the political outcome. Not full ownership. I mean, it's we're all only one tiny little piece of this, but ultimately we all have a stake in it and a real effect on the outcome. And so that's the idea. Citizen capitalism, accountability is that ultimately the economy is a reflection of us, of decisions we make. And if we bring our full selves, our full value set, all of our interests to our economic transactions, as much as we bring them to our moral ones, that we're able to create an economy that is both prosperous and good.
On the economic side, we use our smart brain to earn money, and then we have our moral, philanthropic brain where we write checks and give the money away. And you're saying it should be merged. And another way, I think it was Jed Emerson, I had a conversation with him, he described it, we are all impact investors. Whenever you're putting money into an investment or into your retirement fund or whatever, you are investing, and that investment has an impact. It can be a good impact, it can be a bad impact, it can be an impact you have no idea what it is, but you're impacting something and you're helping bring something into the future. So we're all impact investors. An impact investor just isn't a guy with a hat on that says impact investor.
That's exactly right. No, Jed is very wise. I mean, he's one of the forebearers of this field. We profiled him in our chapter on impact investing, and he's a real instigator and tries to hold the field to a very high bar. And I think he is 100% right. Whether or not we measure it, whether or not it's positive, negative, we all have an impact in every economic decision we make. And if you just zoom out and you look at the big problems we have in our economy, whether it's environmental or inequality, social, climate, or otherwise, those problems and the solutions that are fighting them are a complete result over the decisions we're all making and where we're buying, what we buy, where we work, how we invest, and how we vote and how we donate money and all of that. But ultimately, if we're going to get any real solutions, we have to bring all of that to bear.
If we both agree that we're all impact investors, we're having some kind of impact, you're really talking about being more purposeful about how you're investing. So how then do we build citizen capitalism?
It's partly a normative statement I'm trying to make. This is how people should think about it. We talk about this concept of voting with your wallet. Whether or not you've ever thought of it, you are voting with your wallet with every single coffee you buy, every where you choose to live, everything. But it's both a normative statement of how people should be approaching this, but also an empirical one of how people actually are. This is not, in many ways, we're not looking at a world, that no one has ever thought of this before, and we're trying to bring some new idea. We're looking at the world and saying, this is what people are starting to do, especially younger generations, but all people, I think, are kind of waking up to this idea that if they care about a set of issues, they should care about it in every decision they make. Now, that can be a very overwhelming thought because we make, I don't know how many thousands or tens of thousands of economic decisions every year. And so what we try to do, you get to the end of these sort of nonfiction books and there's always like, so what's the solution? Where do you go from here? And you can make all these wonderful solutions around, here's how companies should be structured and everyone should be a B Corp. And here's how investors, should bring in impact integration into their investing process. But, for the average person reading the book, what does that mean to them? And what we try to take the approach of is, in the investing space, in the business world, everyone always talks about what's the 80-20? What are the fewest things that matter the most to an investing decision, to a business decision? We try to take that same approach to individuals and say, look, we're not going to save the world by torturing ourselves in the supermarket aisle about which brand of organic ketchup is better for the environment. What are the fewest decisions we make that have the biggest impact ultimately, and how do we direct all of our efforts there? The nice things is when you take that approach, one, it lets you off the hook of, okay, so I'm not going to worry about the 10,000 kind of tail decisions. So you can go through your life, without constantly torturing yourself over what's the climate impact of taking an Uber versus whatever. But also it focuses you on the things that really matter. So maybe the thing that matters the most, of all the spending you're ever going to do, you have to earn that dollar first. A full half of the economic, if you think of like the economic balance sheet of an individual's life, over half of it's coming from how you make money. So maybe the most important thing, the most important impact any of us will ever have is through our work. Where do you choose to sell your labor? Where do you choose to devote your career? And what is the kind of ultimate impact of that job? Something we're seeing a ton of when you just look at these surveys of, what are people trying to get out of their work? And over time, the idea of, you work for a wage and then you go and try and have purpose and impact through how you give money away or how you volunteer. You're seeing that totally transform of people really focused on trying to work for organizations that in their view really matter. And they're doing something they believe in. That's big. When you look at how we spend money, how we invest money, you don't have to think about every single little minor transaction. Maybe you think about who are the retailers I trust. Not everyone can afford this, obviously, but if you think about where do I do my grocery shopping, I know that if I go to certain grocery stores or natural food stores, the Whole Foods of the world, I know that they're putting a lot of effort and expertise into picking what goes onto their shelves. And so if I can make a single decision of, when I can, and again, it's a privileged thing if you can afford it, but when I can, I shop at farmers markets. But I'm not going to worry about once I'm at the farmer's market, what's the carbon impact of a turnip versus a carrot. Like you can make a couple of those big decisions and then let the smaller decisions, slide a little bit. That's kind of the practical implications. And then same thing with investing. How do you take an approach to investing that resonates with your values and your interests?
How about someone running a business? How can they become a citizen capitalist?
When we looked at, because we spent so much time trying to find what are the right businesses to profile, the right people to interview for the book, I think the people for whom this was most intuitive, this idea of balancing stakeholder interests and balancing short-term needs with long-term, the people for whom were doing it the most intuitively were business owners, especially small business owners. Because if you think about, if you own a small business, you are very intimately aware of the consequences of your decisions. When you fire workers, you're the one doing the firing. If you're polluting, the local river, it's your river you're polluting. If you're sponsoring the local Little League team, it's your friends whose kids are wearing, the name on the back of the jersey. And if you're answering only to yourself, the things that you care about are not how do I maximize profits this week or this month. They're how do I create as much value in this organization as I can over the long term. And that to do that, you need to treat your workers well. You need to treat your consumers fairly. So I think this idea of balancing stakeholder interests to create long-term value is very intuitive in a small local context where it becomes quite difficult when you're running PepsiCo, when you're running a large national organization. And that's where some of these solutions around transparency and metrics and ESG investing, that's where things, get get harder. But in many ways, the goal is the same, which is bring back in this kind of intuitive balancing of interests and of time periods that exists oftentimes for folks who are running businesses themselves.
My question is citizen capitalism a model that could cut through the noise of the so-called ESG culture war and appeal to both sides of that debate?
Talk is cheap, right? Like talk is easy. I think one of the big challenges over the last 5-10 years is that, especially as stakeholders have started demanding more from companies, that the easiest, fastest thing for companies to do is some of the more superficial stuff. What statements do they make? Where do they donate a little bit of money? These kind of philanthropic side projects, maybe some of the virtue signaling stuff. Those are the easiest things for companies to do. Much easier that than totally reformulating your products or changing your supply chain, the core of the business stuff. What we focused on in Accountable, what I think most impact investors focus on, is not that superficial, noisy stuff. It's the core of what a company does, where kind of impact and economic value collide. And I think that's the stuff that's actually the least controversial. Like when you look at, if you're sitting boardroom at Ford or GM or a major auto company today, and you're deciding, we've got capital to allocate, we've got a CapEx budget, should we invest into more electric vehicles or into more internal combustion engines? That is a business decision. It's a business decision that is like intimately tied up with questions around the climate and the regulatory regime and consumer preferences and global competitiveness. And so there's a lot of ESG analysis that's included in that, I would argue. But ultimately, it's clearly a business decision. I don't think there's a lot of cultural war politics that are involved in that. Whether or not you believe at Ford, whether or not you believe that climate change is the most important social issue or environmental issue or not, you're going to look at the business merits of these two decisions, and you're going to be doing ESG analysis as part of that, because you can't make that decision if you're not considering, what do consumers care about, what's government regulation doing, where are the incentives going to be. So, I would argue that for those who are doing it right, impact investing right, citizen capitalism right, you're always focused on what are the fewest, most important drivers within a business, the fewest, most important factors in social and environmental impact. And most often, that's not the kind of noise around the edges, the statements, the culture war, the ESG backlash, all of that. It's on core business questions where have the debate, but you're going to be having the debate not on political grounds, you're going to be having the debate on business questions. It's going to be a debate in numbers more than it is in anything else.
So are you saying you're going to be doing this analysis one way or the other? If you're executing your fiduciary responsibility, you just might not put a score on it, like an ESG score.
Yeah, you get this all the time, right? Like this right now, especially. We wrote, Warren and I had written an article in the Harvard Business Review with the title, "The ESG Backlash is Coming," a couple of years ago. But we were right, the ESG backlash came, but we were actually wrong on which direction it would come from. We were arguing that there's going to be an ESG backlash because the true believers in it were going to become so frustrated that there was no fundamental changes being made. It was all, kind of the superficial side stuff, but not, the core business drivers. And ultimately, the backlash came from the other side. Is people who were so pissed about the superficial stuff, that they were saying, we don't want any ESG analysis. And what we would argue is, if you are trying to execute your fiduciary duty, if you're trying to maximize long-term value in your companies, you cannot do it without considering social and environmental factors. Because ultimately, if your customers care about that, if your employees care about it, if regulators care about it, it is going to affect the raw economics of your business. And so if you're trying to maximize the raw economics of your business, there's no way to do that assessment without also focusing on the social and environmental impact that your company is having. You might come to the assessment that, okay, in this case, actually, building another internal combustion engine plant is the better argument, but you're still being forced to do that ESG analysis as part of it. Now, a lot of people just don't want to call it ESG analysis. Fine, they want to call it something. They want to call it risk. They want to call it. That's all fine. But my argument would be like they're still doing it, and the idea that like you should just throw out ESG or the ESG is unrelated to fiduciary duty ignores what at root is actually happening.
When you got out of Stanford, you joined Engine Number One, and this was in its early days. And for those listeners who might not know, Engine Number One was a relatively small hedge fund at the time. And you were involved in one of the most successful impact-focused activism campaigns in history, launching a shareholder activism campaign against Exxon, of all people. Somehow you successfully replaced 3 members of Exxon's board, despite holding, I believe, only something like 0.02% of the company's share capital. So can you remind listeners of how this campaign unfolded?
I had interviewed for the book, I had interviewed an investor named Chris James, who'd been a very successful hedge fund investor over many years, who I think had a similar recognition to what we've been talking about, that if you were trying to maximize shareholder value, you have to take into account the other value that companies are creating or destroying for their stakeholders. And that over long, long periods of time, ultimately the companies that will be most successful are the ones that are generating value, not just for their shareholders, but for their workers, for their communities, for the environment. And ultimately that gets reflected back into shareholder value. And so he was at the early stages of building what became engine number one, building an entire investment firm built around this thesis. And I had also written about another investor, Charlie Penner, who had been at Jana Partners at the time, who really is the brainchild of the Exxon campaign, was his brainchild, because he'd been at Jana doing traditional hedge fund activism and had started to pioneer this approach of focusing on ESG issues. He hasn't always used that terminology, but focusing on more kind of the intersection of social and environmental issues with financial issues. And he had run this very successful campaign at Apple focused on screen time and kids' use of technology. It was in partnership, California Pension Plan. And the two of them had really come together to launch this Exxon campaign with this thesis that Exxon, by ignoring how the energy transition was unfolding, was actively destroying value for its shareholders. And that the board was not well suited to providing the sort of governance you needed to navigate the energy transition. So not to necessarily take a point of view on exactly how should Exxon act on every single one of their decisions. That's not the shareholders' place to decide. That's why you have managers, that's why you have boards. But that we needed a board of directors with the right energy experience to enable that company to move forward in a way that took into account how society was changing around climate. And so Charlie and Chris James had led this campaign. And as you said, proved that even with a very small ownership share, that if your ideas are strong enough and closely tied to financial value, so that you're not just appealing to the climate activist set, but you're appealing to the mutual fund managers who understand climate but don't necessarily buy into it as a core driver of financial value, but understand that for a stock like Exxon, this was a core issue that they were going to need to navigate, not just over the next 6 or 12 months, but over the next 6, 12, 25 years. That's what the campaign was able to do, and is able to come at a time when shareholders were really frustrated with what was happening at the company and the governance of the company, and ultimately were successul, as you said, putting 3 new directors on the board.
How did you engineer this? Strategically, how did you guys execute that?
It's funny because we don't always think about it this way, but the way our public markets work are like little democratic republics for each company. Companies have shareholders at every annual meeting. Those shareholders elect a board that represents them, and that board appoints management, CEOs, to then execute the strategy of the companies. And so, very rarely do we have contested board slates and contested elections, but the structure of our public companies allows shareholders to decide every year, do we have the right leadership? Are our interests being properly represented? And as a result, if you're an activist hedge fund, or if you're running a campaign like Engine Number One's at Exxon, your job is not much different than running any sort of political campaign. You have to go build coalitions. You have to make your case. You have to go convince a lot of folks, some of whom are natural allies, some of whom might not be, that your slate of directors, that the board members you're putting forward, will better represent their interests, will lead to a better outcome for the company than the ones that are currently on the board or the ones that they're otherwise selecting between. And that's what really Charlie and Chris James were able to do, is they were able to go and make the case, investor by investor by investor, shareholder by shareholder by shareholder, that this slate that we were putting forward was going to be better overseers of Exxon's strategy, of Exxon's path forward, than the alternative. And the reality of our public markets is a lot of shares are concentrated in folks like Vanguard and BlackRock and State Street, Fidelity, these massive money managers. And so ultimately we're able to convince those players and many, many others that this was the right slate. But it does take, it's just like if you're trying to convince someone to invest in your company or invest in your fund, you got to take them through the materials. I don't know if the website might still be up, I'm not sure, but reenergizexom.com was the website that was created, and you could see the 100-page plus deck that the team had put together that goes through it, makes the financial argument. It doesn't make the save the polar bear argument, it makes the financial argument for why does Exxon need a new set of leadership to try and direct it going forward.
Why did you target Exxon? What led you to believe that you could take on one of the world's largest energy companies?
Yeah, so the thing I learned be with engine number one is there's really two reasons, and you need this intersection, especially if you're going to be focusing on more social or environmentally driven activism. You need this intersection between this is where the solution sits or where the problem sits, like whatever the old joke is of why'd you rob the bank, and that's where the money is. It's kind of the same thing. If you just look at the emissions associated with different companies, Exxon's right there at the top. So the part of it is just if these are the sorts of issues you're building campaigns around, those are the companies we're going to have the biggest part of the problem. And then the other part is you got to go where the financial opportunity is. Ultimately in the public markets, you're always fighting against the stock price. If Exxon's stock had been flying through the roof, on a huge tear, everyone's making tons of money, it would have been very hard to convince shareholders that now is the time to change, right? But if you catch them at a moment when actually shareholders are already voicing their disapproval by selling the stock, shareholders are already bearish on the future outlook of the company, that's the right time to be able to come in and say, we've got a different vision. We think there's got a different direction of this company that will create more value for you and other shareholders. So there has to be this sort of opportunistic moment of being able to come in and both having the right long-term vision, but being able to take advantage of the right short-term dynamics of shareholders are already upset. They're already looking for a solution, looking for a change. And if you as an activist or as an investor can come in with that solution, with that alternate vision, I think that's when you're going to find the most receptive audience.
Were you expecting the level of success that you had when you started?
I think CJ and Charlie would not have run the campaign if they were not expecting success. But I don't think anyone was prepared for the amount of broader public publicity that would come out of it. There would be front page news on the New York Times, and there'd be a daily episode about it, and a big feature in the New York Times Magazine and everything. And I think that ultimately showed that these sorts of questions around, what should big public companies be doing? What's the role of shareholders in kind of pushing for change? These questions like the public wanted to hear about, the public wanted to engage on. And I take it as a really positive indicator for the broader movement around ESG and sustainable investing, that people who do not necessarily pay attention, on the day-to-day of the financial markets, all that, we're extremely engaged on this question of, how do you catalyze change in different industries?
What are the lessons learned about shareholder engagement that you think your experience with Exxon highlights for others? And just yesterday morning, I read in the FT that Exxon just paid $60 billion to acquire Pioneer Natural Resources, which will immediately double Exxon's Permian Basin daily production. Exxon's current chief executive, Darren Woods, was quoted as saying something like, as long as the world needs oil and gas, we'll be focused on making sure they have the most efficient, effective, and responsible operator making and producing oil and gas and doing it with the lowest carbon intensity, something like that. What does this mean? Engine number one won the battle and lost the war, or what do you do with this latest information?
I've taken three takeaways, from both the campaign and also everything that's happened since. The first is that when it comes to corporate engagement and activism, in the private markets, where I've spent most of my career, your influence on the company is somewhat proportional with your ownership. If you own a third of of the company. You're a venture investor in a third of the company. You've got a third of the board seats. You have a third of the influence. Sometimes a little more, sometimes a little bit less, but roughly proportional. In the public markets, nearly everyone has zero influence, and some tiny number of investors have massive outsized influence, either because of their strategy, they're an activist, or because they've got the ear of the CEO, or because they've got a big public platform. But the reality is that within, there's a reason why public markets, there's so few activist hedge funds, but the ones that do exist can truly change the course of companies. With engine number one had an especially small portion of the market cap of the company, but even large activists rarely own more than 5, 6, 7%, right? And so the first takeaway I think is that within the public markets, you have a very few number of shareholders who have a mass amount of influence. And so if your strategy is let's go push for change in public companies of any sort, change focused on short-term profits or change focused on long-term sustainability, whatever it is, you have to have a strategy that recognizes that most investors have very limited influence and a few investors have huge outsized influence, right? And that's just got to factor into your theory of change. That's the first. The second is that to be successful in the public equity markets, where still a majority of shareholders a vast majority of shareholders are financially motivated, financially focused, they're in the what's in it for me mindset. And so if you've got some theory of value that is anything more than, this is going to juice the stock price tomorrow or this week or this month, you've got to be able to make a very strong financial argument for why it's going to benefit the other shareholders of the company. And so every single argument in favor of more long-term thinking, treat your workers better, to reduce churn, to lower the long-term onboarding costs, and ultimately increase the long-term value of the company, you've got to be able to put all of that into financial language, financial terms, if you're going to be able to get the support of managers whose compensation is tied to share price, other shareholders who obviously care about share price. So to be effective, and I think the same thing is true in the private markets too, to be an effective advocate, be an effective catalyst for change, you've got to be effective in making the financial argument. You've got to really believe it and be able to show it. And then the third, maybe most directly to your points about what's happened to the company since, is that true impact often, it can only be measured against the counterfactual. What happened because of our investment, because of our campaign, versus what would have happened otherwise. And the impact is the delta between the two. And the challenge with the sort of activism that talks about transformation is, you can imagine a wildly successful outcome, given the size of Exxon, is to shift it 5 degrees in one direction. And because of the size of Exxon, that 5-degree shift over long periods of time equates to a huge amount of carbon emissions abated, for instance. But that 5-degree shift, someone could look at it before and after and say, oh, it looks basically the same to me. Exxon's still Exxon, Exxon's still pumping oil and natural gas. And that's the reality of it. You might be able to actually claim a huge amount of positive impact for a given business, but still have a business that on net is contributing to climate change. That's the reality of it. And so that's where I think I tried always to push myself to be especially pragmatic in these sorts of questions, of to say, if what my goal is to not to look virtuous, not to have a portfolio that excludes anything that I might disagree with, but to actually drive change. Basically, if I care about not the emissions in my portfolio, but the emissions in the atmosphere, then that means I have to be willing to do some of the hard work of saying, how do you create a delta, knowing that what matters is what happened versus what could have happened or would have happened, and that will always be in some ways inherently unknowable because we only have one version of history. We only know what did happen. We'll never know. We'll always have to debate what could have happened.
Could what engine number one achieved with Exxon happen again today somewhere else, or was that a product of a specific time and place?
I think things like, GameStop, some of the meme stocks, I think that was a product of a time and place. People were super engaged on Robinhood, people were at home, people had stimulus money. Like, there were conditions you could imagine saying, like, what happened then could not happen now. I think this idea of catalyzing transformation by focusing on long-term issues, including environmental and social issues, I think absolutely. I think it's hard. There's a reason why there's not 1,000 activist hedge funds out there in the world, and the reason why there's not 100 ones focused on social and environmental issues. But I think you're seeing in private equity contexts a lot. You're seeing great CEOs who are transforming their own businesses from within. So I'm a big believer that underlying shift of, if this is a large social and environmental issue that our stakeholders care about, and as a result, regulation is shifting, consumers' behavior is shifting, employees are shifting, competitive dynamic is shifting, that you can create value by shifting your own company, by addressing it, that opportunity is still there.
If you were starting out with engine number one again or now, are there firms or sectors that you'd be looking at as potential targets that perhaps you didn't at that point in time?
I think you always have to think about, in doing this sort of work, is where is there the clearest intersection between social environmental issues and the core economics of the company? Because that's where you'll be able to create the most value. You'll have the most allies in driving the change. You'll be able to make the strongest case for transformation. I'm obviously biased. I work at a consumer investment firm, but I think the consumer sector is actually one of the clearest cases where the logic loop between the impact a company has and its economics is very tight. Either consumers care about it or they don't. They're changing their behavior around it or they aren't. But we see so clearly right now how consumer, not just sentiment is changing, but consumer behavior is changing to the great benefit of the companies that are leading on these sorts of issues. I think there's a lot of opportunity within the consumer space for those who are willing to lean forward and create the sorts of products and services that the consumers are looking for.
When you were at Engine One, you were responsible for overseeing their approach to active ownership. What was your theory of change at that point?
When we were working on Accountable, when Warren and I were writing that book, you're always looking for the right stories to kind of frame your argument around. And it's hard to get these better stories than activism, because it's, feels like good versus evil. There's this fight. It's like a courtroom debate, and it ends in this big climax. Someone wins, someone loses. Plus, you've got the wonderful thing of a share price to then be able to assess, years later, who is right. Did this create value or destroy value? And one of the amazing things we found as we're looking at all these cases of activism and trying to find the right stories to tell is, as we were talking about earlier, activists often only own a small portion of the stock. It was everyone else, ultimately, in how they voted that determined who won. And the crazy thing about that is, the everyone else is us. It's, all of our savings that are in index funds that are being held by BlackRock or Vanguard. One of the shocking sort of things for me as I was doing this research is to find that we'd find some case of activism that felt like a pretty clear, good versus evil. They wanted to break up the company. They wanted to ship the jobs overseas, whatever, for short-term value that ultimately ended up, being value destructive over the long term. And I would look back and say, I held shares in an index fund while that was happening. My shares were voted on my behalf. How did I vote? And to discover, actually, my shares voted to support this campaign that if anyone had asked me, I would have been vehemently against. And so much of the theory of change when we're building engine number one, and especially the part of the business where I was most active, which was in launching our ETFs. We created a couple products that were essentially, you can think of as like index funds, like an S&P 500 fund, but that rather than excluding companies or sectors that you thought needed to change, it would include all of them as just part of the index, and then vote in ways that were more aligned with your interests, your values, what you thought was the right long-term thing for those companies or that sector. So to support more climate disclosures or to support more social and environmental proposals. So the idea being, we all have a stake in these companies. Through my own retirement account, I'm no different than most. I've got a stake in thousands of companies around the world, just through index funds. Those shares should reflect my interests. They should reflect my values. They should reflect my theory of what's going to create value over the long term. And it's not what's going to maximize share price this quarter at this company. It's what's going to create the greatest long-term sustainable development of the economy. And oftentimes those are things that intersect very well with social and environmental issues. And so basically the theory was we need to engage in ways, we need to vote in ways that represent those shareholders, those long-term diversified interests that oftentimes intersect with what would otherwise get labeled ESG.
I speak with a lot of people on this podcast, and there's a lot of people who question whether you can create real impact in the public markets. And usually citing the buying and selling of shares occurs on secondary markets. And how does that have impact? You got a buyer and a seller, but the company's really not involved in that. Is the engine number one Exxon story an exception to the rule, or are most investors just not aiming high enough? And yes, you can really achieve impact in the public markets, because I notice you're now back in the private markets, and I'm making you carry a lot of water to get to what you're doing now. But can you address that? Can you have impact in the public markets?
It's such a good question. We had a chapter in Accountable on the divestment movement, where we spent a lot of time with the Harvard students who are leading the divestment movement at Harvard. And it's hard because as a financial professional, I try and look at all the research, all the studies. I understand, if you're selling the share, someone else is buying the share, and if your theory is, if so many of us sell, we're going to increase the cost of capital for these companies, make it more expensive for them to raise equity, invest in new projects. But the reality is that they're net distributors of capital right now. They're issuing dividends. They're not raising new equity. These large oil and gas majors, for instance, and that. The inverse of increasing a company's cost of capital is you're also increasing the expected rate of return for other investors. So if you're successful, are you actually making the more morally ambiguous investors, sin stock buyers, more successful? And then you look at all the results of despite the trillions of dollars committed to divestment, is there even any evidence that that's even happened or not? So you have all these tricky questions around the theory of change of divestment. And the amazing thing, maybe it shouldn't be so amazing, maybe it should be not surprising, is when you talk with the student leaders of these movements, they've read all the same studies. They understand all this as well as we do. I mean, for people who are kind of critiquing from the sidelines, these are people who have devoted their lives, their student lives to these issues. They're more deeply steeped in the research than anyone else is. And what you realize is they've got a bigger theory of change. Their theory of change is that if you can make these front and center cultural issues, that's what's going to create the conditions for a carbon tax, for legislation, for, think about all the students who've gone through universities while divestment protest is happening, whose views about climate change and fossil fuels and whether or not they should buy an electric vehicle, are so shaped by this fight, by this movement. In sort of a perverse way, actually, the harder and the longer the fight is, the more successful it is, because the more it's front page news and front of mind for students and other folks. So I would look at the divestment movement and say really tough direct theory of change, but potentially very compelling indirect theory of change. And I think most people in the movement would say the same thing. Would say the direct theory of change, we get it. Cost of capital not going to happen. You can't affect these big corporations. There's a seller for every buyer, a buyer for every seller. But look at everything we've accomplished by all the organizations that have made this a front center issue. Now you get outside of divestment, you say, well, what about all the engagement? The engagement you can do with these companies too. Can you force them to change more directly? That for sure was engine number one's theory of change. Is engine number one's theory of change. And I believe in it, but with the caveat I said at the start, which is our public equity markets have always had this, I don't know if it's a feature or a bug, but it's a reality that most shareholders have very, very little influence, and that very few shareholders have massive influence. And so I would just say that what engine number one showed is you can be a tiny shareholder, but if you make a strong enough case and put together a good enough campaign, you can have real influence. And you can be a massive shareholder, you can be BlackRock or Vanguard or otherwise, and you can have very little influence. It's not a result of, do we own a lot of shares or a few shares? It's what are you pushing forward and how are you doing?
How would you describe what it was like for you doing impact investing at a big traditional firm like Bain Capital versus the new disruptive firm like engine number one?
There's something very nice about being at a dedicated impact firm where you can put on the front of the website, all we care about, we have a single theory of change, single theory of value. Everything we do is tied to these principles. There's something very nice about that, and to be able to look around and say the whole firm is bought in on this. As opposed to, I think, what you'd probably find at many traditional asset managers, that have an ESG department or have an impact fund is, clearly people on the fund are true believers, but there's going to be plenty of, middle managers elsewhere in the firm who think of it as some sort of philanthropic thing, don't really believe in it. And so you end up doing as much proselytizing inside the firm as outside the firm. So there's something really nice about that. Now on the flip side, L Catterton, where I'm now, has $30 billion plus of assets under management. Bain Capital, I don't know what they are right now, $100 billion plus of assets under management. Ultimately, how do we see solutions? We've got, in the grand scheme of things, impact investing is tiny. Less than 1% of global assets under management. You can't solve the problems we want to solve with less than 1% of assets under management. So our broader theory of change has to be that we are somehow affecting the way all investing is done. And that starts with, with your own firm. And I think what we try to do at Bain, what we're trying to do here at L Catterton is, can we be the laboratory, that proves that, certain ways of measuring, focusing on certain issues is a better way to invest. And as a result, shift not just, the 10 or 15 or 20 companies we invest in, but the hundreds of companies that the broader firm touches, and ultimately the thousands or tens of thousands of companies that the sector touches. So I think the nice thing about building on big platforms, besides having all the resources and the advantages that come from that, is that you can also have this broader theory of change that, what we're doing ultimately has these ripple effects that start in our fund and our firm and ultimately, across our sector.
You relatively recently landed as a partner at L Catterton, which is one of the world's leading, well-regarded private equity funds focused on investing in well-known consumer brands. And there you lead impact for L Catterton. So how did this move from engine number one to L Catterton come about?
Yeah, so I get to co-lead the strategy with an amazing investor, Tamina Hayter, who had been on our growth fund for many years, had led growth at Harry's, the Razor brand, and came back to lead the strategy with me and is an amazing partner. L Catterton, a lot of what we've talked about, this idea that impact and financial value are intertwined, you can't disaggregate them, can't decouple them. It's debatable depending on what sector, what company, what economic decision you're looking at. Within the consumer space, it's pretty clear. And so, if you go and talk to the partners at L Catterton, you look at our history, the deals we've made, you can go back and look at diligences we've done on companies 10, 15, 20 years ago. And you can see the survey work on consumers are caring more about health and wellness. Consumers are caring more about waste. Consumers are caring more about sustainability. So this idea that impact and economics are connected is just part of what it is to be an investor in the consumer world. I'll take an example. Try to launch a beauty brand today that does not focus on clean ingredients, non-toxic ingredients, not focus on more sustainable packaging and more inclusive coloring, almost non-differentiating to focus on some of these things because it is so now clearly demanded by the consumer and therefore where the opportunity is. So L Catterton has been seeing this unfold, has been investing behind this in a lot of their funds, and I think saw the opportunity to say, what if we were to create a new strategy solely dedicated to just these sorts of mission-driven consumer companies, companies where impact is at their core. It's why the founders started the company, why employees want to work for the company, why retailers want to carry the brand, why consumers are attracted to the brand, why they're differentiated versus their competitors. It was a real opportunity now to create a strategy around that. And I spoke with the co-CEOs, Scott Danke and Michael Chu, and they were such big believers in this opportunity. I was so excited about the opportunity that ultimately now, almost 2 years ago, we were able to come together and start putting together what's become L Catterton Impact that really builds on so much what the firm has done for its 30 plus years.
With that, why don't you give me just a 30,000-foot overview of L Catterton, maybe get down a bit more in the weeds and tell us about what you're doing now and about the new impact platform that you're building and what your vision is for that.
Sure. L Catterton, for folks who don't know, one of the world's leading consumer growth equity investors. Brands in our history like Birkenstock, which just went public earlier this week, and Restoration Hardware and Cholula Hot Sauce and Norwegian Cruises and a whole host, 250 plus different consumer companies we've invested in over time across 9 fund strategies and Asia, Latin America, and the US, and in Europe, all consumer. And taking a very thematic approach to how we invest, of trying to identify what are the deep structural underlying changes in consumer behavior and consumer sentiment over time. Things like consumers' greater focus on health and wellness, or on the humanization of pets and treating pets like part of your family. And then all the different categories within the consumer sector you can invest in behind those deep structural themes. And the idea with L Catterton Impact is that many of those themes are inherently impactful. If consumers are becoming more and more aware of the waste they create in their consumption, the plastic waste that comes, the daily inundation they have of products, or the food waste. A huge part of the food waste challenge in the US and across the world is happening at the consumer level. The food they're throwing in the trash is ultimately rotting in landfills and releasing a huge amount of methane emissions, contributing to climate change. If consumers are caring more about this issue, that means there's a huge opportunity for consumer companies and consumer investors to back solutions to these issues. And that was a lot of the catalyst now of a lot of the work that we're doing and the firm is doing of how do we find those companies, those mission-oriented founders that are creating solutions that are resonating with consumers and really hitting that overlap between impact and economic opportunity.
So you coming to lead impact at L Catterton, is that going to be a new segment of the company, or is this more to provide strategic overview to integrate that across the company?
Now, we saw a real opportunity with early stage growth companies to create a new strategy to provide capital to them. And so we've got a new team sitting here in New York. There's 8 of us all together, together with my co-lead, Tamina. And the idea is that this is really an incremental opportunity for the firm and one that right now to create a dedicated strategy solely focused on impact, we believe gives us a real advantage in finding and partnering with that next generation of companies, that next generation of founders who aren't just looking for capital, aren't just looking for expertise, though they are, but they're also looking for impact alignment, mission alignment. Investors who believe as much in their theory of change, their theory of value as they do.
And what are the consumer sectors you're most excited by right now? And what are the parts of the consumer landscape where you see the greatest opportunity to create impact?
We look at the world through 3 lanes. We think about companies making the economy cleaner, healthier, or more equitable. And within cleaner, that's around climate change, sustainability, reducing waste, including plastic waste and food waste. Within healthier, that's reducing disparities in health and wellness and nutrition. And within more equitable, it's thinking about financial inclusion and education, workforce upskilling. And so it's a relatively broad aperture on the areas where consumers are having a real impact. But it's this narrow focus on where are there companies that touch the consumer, that have found a model that creates real solutions and is making a real economic profit, providing those. As a firm, we always try and take this very thematic approach and say, okay, here's your problem space, here's your opportunity set, but where are there real tailwinds, enduring secular tailwinds to invest behind? And I'll just give you a couple of examples. One would be around home electrification. You look at something like the transition towards electric vehicles. That was in no way assured 10 years ago. But now you look at both government incentives, consumer behavior, where the OEMs have gone and completely retooling their supply chains, their manufacturing base to transition towards electric vehicles, all the commitments and mandates to go fully electric in new car sales by 2030 or 2035 or 2040. You say, here's a very, very long-term secular shift towards electric vehicles. It might be slightly faster, slower in different areas. It might be 3 steps forward, 2 steps back, but long-term we're big believers that by 2050, we will have made this big jump. And so what are all the implications that's going to have on not just what cars are being sold, but how we're going to charge? And where do we go when we're charging our vehicles? And how are retailers going to change their parking lots? How are they going to partner with electric vehicle charging company? And at home, as we think about electrifying the home, how are we going to connect solar panels, and batteries, and electric vehicles, and induction stoves, and electric heat pumps. Here's a big, important part of the challenge that consumers play a critical role in, and where there's a huge amount of economic activity, hundreds of billions, if not trillions of dollars that's going to be spent, in coming years. That's an area where we see real opportunity. Another one is related, but coming from a different angle, is who's going to be doing all of that work? How are we going to be able to upskill an entire generation of new electricians and climate workers to enable all of these transformations that we're otherwise expecting? So a lot of opportunity on the upskilling side, on the workforce training side, to meet that opportunity.
You've really implied that impact investing is really a logical progression right outside the labels that anybody executing their fiduciary responsibility, either as an investment manager or someone running the company, they're going to end up considering all the criteria that one considers in what we would define as impact investing, because it's more comprehensive. I would like to focus a bit right now on what you see as the best evidence that should persuade a skeptical, evidence-focused finance professional that focusing on impact and the ESG toolkit should enhance returns and create real-world impact. So can you make the strong case for why companies that focus on impact should outperform those that don't? Because if this is true, then this should be the way the market ends up going en masse.
Yeah, finance is a show me field, and it's evidence based. Show me the evidence that this is the case, and then if you do, the wonderful thing of everyone having this very narrow incentive around profit and share price and equity value is once you can prove it, that's the direction everyone's going to go. No one wants to leave $1 on the table. The first thing, though, as you approach it, is you really have to separate out the difference between how you might think ESG investing should be done, should be defined, should be measured, and the way it currently is. And so, I think a very typical thing in answering that question, people would point to all these academic studies that try and go back 3, 5, 10, 50 years and try and show correlations between ESG performance of a company and its financial performance, and try and show that if you were to go back to 1990 and sort companies into two buckets, the good and the bad, that the good, outperformed the bad over time. And there's a huge amount of research. Part of the reason why there's so much research here is because the data is so good. We've got stock price performance over time. You can try and create proxies of different ESG measures over time. The problem, though, is the moment you start, and I should say, that evidence is good. It's you can find studies that say everything, but if you try, there's a bunch of meta-analyses that go out there and say, or take all 1,500 studies and analyze them. And I can't remember off the top of my head, but 60% of the studies, 70% of the studies would say, if not neutral, it's positive on shareholder value to be a company that does the other things right, treats its workers well, and all of that. Problem, though, is I think a lot of the backlash over the last couple of years is that how these ESG measures are created is a subject of some controversy and debate, with no better indication that if you just take the same company at the same point in time and go to 4 or 5 different ESG ratings companies, there's going to be very little correlation between the ESG score for that company. Which is odd because if you ask 3 or 4 different credit ratings companies, what's the credit rating for this business, they all triangulate around the same score. But if you look at ESG, it's all over the map, because how do you decide how to weight wages versus water use? How do you put those things on a commensurate plane? Everyone's got a slightly different answer. So even though I think that would give you some indication that ESG is not destructive to value, this is something you should be willing to invest behind, I think in many ways it raises more questions than it answers. So for me, that would be the first point, is that we need to separate out how should an ESG investment be done versus how is it done. I think the second point is to come back to, you really need to be focused on the core of what companies do. Not the policies they necessarily have, what metrics they track or measure. Do Do they report on their carbon emissions or not? Should that be a point in their favor or against? Like, what are the core products and services of the business? And what is the core impact of those products and services? And then look at the performance of that sort of thing. That should be, if you're trying to convince a manager to make decisions that take into account the impact they have, look at the core business decisions they're making. And here's where, like, I'll use a consumer example because I'm in the consumer world now. If you were to look at all CPG products over the last 10 years, all the different consumer products we buy, soap and food and diapers and all of it, and you were to sort them into two buckets between those that are making sustainability claims and those that aren't. NYU does some great research on this every year that they update. And so, all you're doing is you're taking the actual products that people are buying day in and day out at the supermarket, and sorting them by those that are more sustainable and less. And what you can see is that more sustainable products are outgrowing the less sustainable by a factor of 2.5 to 3 times, right? And that's not some question about, how are shareholders valuing this? This is just like raw dollars. Are consumers changing their behavior because of sustainability trends in this category? Look at the M&A that big CPG companies are making, Nestle, Unilever, others. Over half of their M&A now, at least by our analysis, over half of their M&A now is in these sorts of companies that are more sustainable, more ESG forward, because they recognize the same thing that data says, which is that consumers care about it, they're changing their behavior, and the companies that lead will be the ones that benefit. Now, that is a micro argument just about CPG, just about sustainability, just about the last couple of years. But I think that brings forward a greater truth, which is ultimately, this is a contingent question. Companies can be more profitable focused on ESG only insofar as consumers care about it or employees care about it. Like, it might be the case that right now, the value maximizing thing to do is come out with a net zero clothing brand. Maybe, I don't know, it depends. It might be the case that 10 years ago, that would not have been the value maximizing decision, because 10 years ago, consumers were not changing their behavior based off of their carbon footprint. And it might be 10 years from now, it's not the value maximizing decision. But the reality is, if you come back to this idea of citizen capitalism, the reality is that business decisions are good or bad depending on everyone else's behavior in the system. What do retailers want to carry? What do consumers want to buy? What are regulators? What are the incentives, regulations? What are competitors doing? And, in many ways, the argument that I'm trying to make is very narrow. It's not that always and everywhere it is an iron law of economics that doing the good ESG thing is the profitable thing. I'm making a very contingent argument that based on today, the way that consumers think about these issues, the way that investors think about these issues and regulators think about these issues, that the profitable thing today is to focus more on impact. And I think that's one where to make that argument well, you have to go company by company, sector by sector, business decision by business decision, and look at the raw evidence of how money is being spent.
L Catterton's focus is consumer brands. There's an argument out there that some people would say that there's a tension between growing consumer brands and impact. And no matter how light the footprint of a consumer company is, these people would say that ultimately we could have more impact by consuming less rather than more. What do you say about that argument?
It's a very tempting one, because, all of us have a carbon footprint. Every exhale we have, we're exhaling emissions. It's very tempting to say, therefore, if we can just do less, then that's the answer. But you look at something like the food system. We have tremendous emissions come from the food system. Tremendous waste comes from the food system, which contributes to emissions. The answer is not to go around and tell people, eat less, right? The answer is eat different. We know that the carbon footprint, the CO2 equivalent footprint of eating, 100 calories of soybeans versus 100 calories of beef is just massive. We're not saying eat fewer than 100 calories. We're saying eat in ways, over time, not every single bite you ever take, but eat in ways over time reflect the impact you're trying to have. And that might mean eat less of one thing and more of another, but it doesn't mean eat less overall. As consumer investors, we say, every dollar earned will be spent. I mean, that's just a fact about the universe. It might be saved for a while and spent later, it might be invested, spent later, but ultimately, like that consumer is going to spend that dollar one way or the other. Our goal is to try and find and invest in the companies where when the consumer spends their dollar there rather than somewhere else, the impact of that decision, the delta between that decision and another is as large as possible. And I'll give you an example, which is in our Latin America fund portfolio, there's a great company called Notco that makes alternative milks, alternative cheeses, alternative proteins under the brand Not Milk, Not Cheese, etc. A glass of Not Milk has something like 75% fewer emissions associated with it than a glass of dairy milk. We're not telling consumers like, stop drinking milk. We're saying, if you're going to drink milk and you drink Not Milk instead of dairy, you have now, from the status quo, from what the world would have been otherwise, the counterfactual, you've now taken emissions out of the environment. No, that's our goal. It's like consumption will happen. And so how do we make sure that the way that consumption happens is having a net positive impact on the environment? And many of the problems we look at can only be solved by shifting consumption patterns. Food waste being a good example of it.
I recently had Ed Markham at the Working Capital Fund on the podcast, and his fund's work and thesis is all about the fact that companies need to pay more attention, not just to the impact of the products that they sell, but to the supply chains that produce those products and bring them to their customers. And he says that when you look behind a lot of the green-looking consumer companies, it is often a much less green-looking supply chain. Do you think about this in your current role and investing activities?
You have to think about within carbon emissions is like the most measured version of this. The reason why people focus initially on scope 1 and scope 2 carbon emissions, the carbon emissions directly coming from what's happening in the four walls of your office, is very easy to measure. And oftentimes it's very small. But where most of the emissions sit, and therefore if you care about emissions, where you need to go focus, is in scope 3 emissions. All the emissions that go back deep into the supply chain. And a good example from kind of an ESG darling company is Sweetgreen. You can go and pull up their sustainability report, and you'll see, I don't know the numbers off the top of my head, 1% of their emissions are scope 1 and scope 2. Almost all of their emissions is coming from the supply chain, from how their food is grown and transported and how the salad bowls are manufactured. And so if these are the issues you care about, then the only way to actually affect any change is by going deeper and deeper into the supply chain. Now, ultimately, the way you justify any changes in the supply chain oftentimes has to be because at the end of that supply chain, there is a consumer that is making a different choice as a result. So I think about something like fair trade, for instance, or organic, certified organic. If you do all that action and then you never tell the consumer about it, the consumer has no idea it exists, you're going to have a hard time justifying the additional trouble and expense and resources that went into doing that. Maybe, and not always, maybe there's other benefits of, if we treat our workers better, we have better retention or we get better productivity. There can be reasons to do things other than just there's going to be a consumer at the other end who's going to be more loyal or is going to be willing to pay more, is going to be willing to talk about the brand more. But oftentimes the way you justify these transformations is that at the end of the supply chain, there's people who are going to be making different decisions as a result. And so that's kind of the nexus that we play at, is how do we make the changes that need to be made throughout the whole supply chain? But where we play, we're not deep supply chain investors, we're consumer investors. How do we do that and affect that change right at that interface between the consumer and the whole supply chain that exists to cater to their preferences?
More companies are staying private, or at least are staying private for a much longer period of time than in the past. And that makes private equity an even more important part of the ecosystem than it has been previously. So tell me, are there aspects that you think private equity investors in general could improve in order to improve their impact practices?
I believe with Jen Emerson, I think all investing should be impact investing. And ultimately, I see our work in this field as the laboratory within which capitalists are trying to fix capitalism. And that our approach of focus on stakeholders, not just shareholders, focus on impact, not just financial stats, and that if you can do that well, it ultimately benefits long-term investors even more. That's what we're trying to prove. And I think if we can do that well, ultimately every investment fund is going to start looking more and more like impact investing, until ideally at some point you can't quite tell the difference between the two. How do we get there? I think about of net promoter scores. Net promoter scores, this idea that one of the most important things for a consumer company, most businesses, but especially for consumer companies, to understand is, do consumers want to tell their friends and family about a product? And if you can create a product or service that is so good that they would say, 8 out of 10, 9 out of 10, 10 out of 10, I want to go tell my friends and family about this restaurant, this brand, this product, you're doing something right. And ultimately, that's going to reflect itself in long-term financial value. It's not prima facie true that that's something that private equity investors should care about. Because maybe it's possible that private equity investors can make more money screwing over consumers and making them miserable. And that's the value maximizing thing. But over the last, whatever it is, 20 years since this concept of net promoter scores came out, it's now like pretty well accepted that you should focus on net promoter scores for their own sake, because if you do that well, a lot of other things will click into place for a brand and for a company. Our goal is that that's ultimately going to be the way a lot of investors look at a lot of other things around how, should employee satisfaction, retention, promotion from within, should we be as focused on that as we are on net promoter scores? I think yes. How do we get there? I think we have to walk the same road the net promoter scores walked, which is proving it again and again and again in 1,000 different circumstances, in 1,000 different ways, that this is something that is extremely material to financial value. And the more successful impact funds we have, the more successful impact investments we have, the more that's going to shine a spotlight on it. Because ultimately, investors are convinced by money. They're convinced by who's being most successful, which companies are taking share, who's having the biggest exits. And the race is on for investors with this particular theory of value to convince others that we've got the right path. And in a bizarre way, actually, this is the ideal moment for impact investors where it's still a little bit contrarian what we're doing. Once every investor all over the world agrees that impact, companies with positive impact will make more value over time, they're going to bid up the value of those companies, bid up the value of those stocks to reflect it, and there will be no more money to be made, no more excess returns to be made as an impact investor. We're not there yet, and so I'm very bullish that now is the time when there's still a lot of questions and skepticism around impact. Now is the best time to be doing it.
If you had to name the single most important challenge to impact investing at this time, what would it be?
I think the challenge is time, because ultimately the feedback loops, especially in the private markets, are very long. You can start a fund today, and it might be 10 years until you know exactly what the final outcome is, final financial return outcome is of that fund. That's tricky, and so time right now is the toughest thing. So if what we are trying to do is what we just talked about, prove it case by case, investment by investment, it's going to take time to do that well.
What do you know now about impact investing that you wish you knew in 2012 when you started working in this area at Bain Capital?
Earlier on in the impact investing world, there's a lot of focus on how can we be differentiated in our approach to measuring impact, and create a proprietary way of understanding and talking about impact. And what I've learned over time is in the financial system, if we can have a certain common set of frameworks, common metrics, common standards, that'll go a lot farther to crowding in capital and to getting LPs, our investors, comfortable with how things are measured. So I think pushing towards standards and frameworks, common reporting systems, I don't think 10 years ago we were talking about as much. There's a big drive there now, and fits and starts and plus and minuses, but I think that focus on common language, common frameworks, common standards is really critical.
You don't have to name names, but can you describe to me an example of an investment that you were convinced of at the time you invested, that it ticked all of your impact boxes or your ESG boxes, but in the end it didn't turn out? What was the lesson learned from that experience?
We've talked a lot about this idea of the counterfactual and measuring impact against what would have happened otherwise. And one investment I'm thinking of now, I think we looked at, is this business, good for the planet? It wasn't solar panels, but imagine like a company that's installing solar panels, how could that not be good? But the challenge is if you can do the thought experiment and say, if they didn't exist, someone else would be able to fill their spot pretty quickly. That's both a problem on the impact side, but it also means that they don't really have very strong barriers to entry. They don't have very strong competitive moat. And so you end up having the twofold problem on impact and economics. And I think that's one area where in the field, myself included, have gone into trouble of if you can't demonstrate that additionality, that counterfactual gap of impact, you're also going to have a problem with competitive differentiation. And that's an area we can get into trouble.
And now the converse of that, can you describe an investment that you were skeptical of, either at the time you invested or maybe you ultimately passed on it, and in the end, it actually turned out way better than you thought, and you were pleased you invested, or if you had passed on it, maybe you wish you hadn't, and what was the lesson learned from that experience?
We had passed on an investment years ago in a business that was focused on supply chain measurement, supply chain tracking, supply chain transparency, for large brands. So you take a Heineken that's got 100,000 suppliers worldwide through its supply chain. They're helping businesses like Heineken to make sense of that, to measure, to report out on it. And we didn't end up investing. The business has done incredibly well as all of these trends that continue to persist. And the lesson to take away from it is, given all the exponential growth we've seen in this sector, the exponential interest we've seen in ESG, it's easy to say like, wow, how much further can we continue to grow from here? And you really do have to zoom out and say, impact investing is still 1%, less than 1% of total assets under management. We are still in such the early frontier days of this approach, of this movement, that even things that feel very mature right now, ultimately, we've got a long, long road ahead.
If someone wants to get into private equity impact investing, how would you advise them to get into the business? Where should they cut their teeth?
I'd say, come, we need you. And I think right now we've actually got great interest, especially from younger investors, younger people of, if the pitch is come be a private equity investor, all the excitement, everything, the reason why people love this line of work, you get to do that, but you get to do it solely focused on companies you really believe in that are having this positive impact on the world. That's a pretty good pitch, and I think we're seeing a lot of interest in it. The word of advice I would have is impact investors are a subset of investors, and the skill set required is the same underlying fundamental skill set of financial modeling and diligence and understanding risk return that is needed for any investor. It's no easier, and in some ways it might even be harder to be an impact investor than a traditional investor. And so I think all the things people think about of when they're just trying to get on the career path of going into the buy side, of going to the financial sector, all those things are needed for impact investing as well. And so, yes, if you want to do climate investing, amazing, understand climate inside and out. You also have to understand investing inside and out as well, because ultimately it's the overlap between those two where we're going to be most successful.
But get a good foundation in the fundamentals, because investing is investing, right?
That's it.
Well, Michael, I think we've gotten to the finish line. It was great talking with you. Thank you very much, my friend, for taking me through all this. I really appreciate it. You have some amazing stories to tell. Now tell everybody your websites and your social and how to get your book and all that good stuff.
No, I appreciate it. Thank you, Scott, for having this fun conversation. The website, www.accountablethebook.com. That's got all of our contact information, all of our articles, and most importantly, how you can find more in my book. We go into all this and more. And otherwise, you can find me on LinkedIn and Twitter and everywhere else, Michael O'Leary and L Catterton.
Okay. And what's the best way for people to contact you?
Reach out on LinkedIn. I'm embarrassingly active on LinkedIn. I'll say that.
Okay. Thank you very much, Michael. And goodbye, everybody.
Thank you, Scott. Thanks all.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.